Oh, wow. Wow. That's what we on today. It's jolyngc in the place to be. What does it, cousins? Can't hear you. Mm-mm. We got to do it again.
Can you hear me now? Can you hear me now? Can you hear me now? Okay, I think that y'all can hear me now, so we're good. All right, so what's good, everybody? I'm Mark Monroe, and welcome to the Come Up Series, a show in which that we talk about wisdom, knowledge, and also everything in between when it comes to the markets and investing in your portfolio. Today is very awesome because I am accompanied by my wonderful co-host, co-producer, co-creator. You've heard her say what she said, and it was all up in my ear, but I said my co-creator, co-producer, co-host, and wonderful friend, and dipping and doing it out here in these markets, the wonderful.
It's jolyngc in the place to be. What does it, cousins? I hope y'all can hear us now.
All right, so if you haven't subscribed yet, go ahead and hit the subscribe button down below. It's just, just take 3 seconds out of your day just to hit the subscribe button and like the video, and on top of that, hit the bell so that way you can be just like cousin Reggie, who was first in the chat. Somebody said that he is more consistent than taxes, so that's something to be said there. Shout outs to you, Reggie, because we do appreciate you. All right, and on top of that, if you are feeling generous, go ahead and share this video with somebody or people that you know or on your social media so that way we can get this message out, because today is all about year 2, sophomore year. So, but before we get into that, because I know that you guys got a ton of questions and I know that Jolynn's got us with this review. So, Jolynn, how do we do in today's markets?
It was a red day. It was definitely red. But let's get into it. Let's get into it. All right, so let me make sure I can read my own handwriting, y'all. Okay, so the Dow was up 194.55 points, leading us to a level of 35,813.80. Then we have the S&P 500, with a little something, just a little splash, 7.76 points, which leads us to levels of 4,690.70. Then the NASDAQ. It did come back though, y'all. It was down by like over 200 and then it came back a little bit, but it's still in the negative. So it closed at negative 79.62 points, leading us to a level of 15,775.14. We got the VIX acting up at 19.38 points. And we have the 10-year Treasury note coming up a little bit to over 1.66 percentage points, heading on over to a sector performance. As you know, there are 11 sectors, and we track the top 3 and the bottom 3, so we can see what that rotation is looking like. So we have energy, financials, and real estate holding it down in the top 3, and then for the bottom 3, 2 of my faves down there chilling, holding it down. We got tech, tech, communication services, and consumer discretionary, all at the bottom. And don't worry, y'all, we will talk about this rotation, and we can see the correlation between bond yields and stuff rotating out of growth. Now, for our pick performance, no 52-week highs this week, or well, today, I should say. However, we have Snap making a comeback. We got the TBT for those defensive plays, as well as Lucid holding it down for the top 3. For the bottom 3, we have C Limited, that's ticker symbol SE. Tesla looking like potentially a deal. We'll see. We'll see. And DraftKings holding it down for the bottom three. So y'all had some questions, which is lovely. Um, and some of them were Google's, but I let some of them slide. And then, but the majority of them weren't really Google's. They're more, you know, conversational. So shout
Okay.
out to those who have the thinking caps. And also, Mark, I do want to say, since we are in Wealth Ritual season for season 2, uh, you know, last year,
Uh-huh.
the first episode was about thinking bigger. And so the challenge in that video was to 3x whatever your portfolio goal was right now. And I dared y'all to do it on a red day. And so really it could have just been an exercise in thinking like, okay, now if I was really going to do this, you know, what would it take? Even on a red day, where would I be? How would I reposition my portfolio? What would I be looking at? What risk would I take? And so on and so forth. So shout out to those of y'all who actually increased your end of the year portfolio goals by 3. So, you know, keep us posted on that. We love to see a good screenshot with a good, you know, 1000% gang, gang, gang. Shout out to cousin Taz and cousin Rachel for that. And Mark, it's my understanding that, you know, this is like a year. So last year we were all freshmen, well, on this journey collectively.
Mm-hmm.
And this is sophomore year. So I feel like the title is fitting.
Yeah.
So how do you want to get into this? Do you want to do some questions? Do you want to you know, pull down the chalkboard, so to speak? What you feeling like?
I feel like, in orientation day on the first day of your sophomore year, let's go ahead and get some questions out of the way because, people may have some questions that, came over from last year or from freshman year, and they just want a quick little refresher, though that we'll get into that in a little bit. So, yeah, go ahead. Let's answer some questions.
All right, all right. So everyone, have a seat. Take your seat. You know, we're calling in attendance now. All right, take your seat. Get your notes ready. All right,
Attendance
so we have
matters now.
yes, okay, for real. All right, so here is a question. Ooh, the typos. Okay, let me see. Let me see if I can make this out. Okay, so what does it mean for NVIDIA for the next few years if that deal doesn't go through?
I think Nvidia will just be just fine. If you look at all the things in which that they're doing, and they're really like just dominating the AI space, like significantly dominating, and then bringing that over into data centers, and then on top of that, it's like they're changing the game as it pertains to gaming as well. Like one of the things that I was talking to people about earlier today was, people were like, well, Nvidia is kind of like bottleneck with all the supply chain issues of their graphics cards getting out. But what if Nvidia was like literally putting those graphics cards in their cloud space and making it available for you to literally pay $100 every 6 months, so they gain $200 every year off of that graphics card? And you know how subscription services are. Once you're in, you're in. Most people forget that they even have subscriptions. If you forgot that you have subscription services in your accounts, or that keeps pinging your account, go ahead and just throw up an emoji in the chat. Um,
Which emoji? Which one should I throw up for that?
Throw up the money emoji. Throw in the money emoji.
Okay.
Because it lets you know that, hey, now you're conscious. So, hey.
Right. But if you weren't aware, that also means that you're not on your 70/30. Because if you were on your 70/30, you would know what's going in and out of your account. So going ahead and telling yourself it's
It's
all good.
okay.
Okay.
It's okay. You got to start somewhere. You got to start somewhere. And mind you, this is orientation, so nobody gets like the goon hand on orientation day. So then it's like if you think about it, like Sony, Microsoft are significantly scaled back and bottlenecked due to not having those devices. And so now they're significantly just like starting to dominate and starting to open up that space of being able to provide a specific type of graphics card that everybody wants, now being able
Mm-hmm.
to use that graphics card in specific cloud spaces. And I'm probably sure that if you can prove it within gaming spaces, it's only a matter of time until pretty much like if you needed to do post-production video, rendering and stuff like that. I can only imagine what that's also going to look like in the next few years. So the future is very bright, and alongside what they're doing with their NVIDIA Drive platform, the Omniverse, and the real-time AI and machine learning processing. Honestly, it's like they really come second to none across the entire landscape and the board. So honestly, the future for NVIDIA is very bright, whether or not the ARM deal is in place or not. The ARM deal is good because of the fact that it allows them to speed up that processing and design. But yet, at the same token, I mean, that's just nothing but a feather in the hat for NVIDIA. You know, even if you don't have the feather, the hat still looks dope. So
Okay, so that answers the second question about the CEO of NVIDIA, Jen, talking about
was it
what he,
Jensen or was it his AI?
well, the comments about, what was he alluding to? So you just answered the question that another cousin had. So
Yeah.
okay, that was 2 for 1. Okay, here's a question. Will rising rates and tapering be a tailwind for financial sector?
No, actually, rising rates are nothing but, pretty much giving it that extra emphasis, which will win to aid, which will push financials forward because a lot of financial institutions, including significantly your regional banks and your investment banks, I mean, this is huge for them. So, hence the reason why, if you're seeing this rotation coming out of fintech but going into major financials, it makes all the sense in the world because of the fact that in a world of rising rates, they win. So, I think that, yeah, congratulations to financials. And I think that this is going to be a year where we start to see them, really come into the foray alongside the other major players within the space of the sectors. So I think that, yeah, nothing but good things ahead for the financial sector, unless we roll back on rate hikes. So if
Mm-hmm.
the market doesn't get the amount of rate hikes that they expected, then that can potentially cause some challenges.
Okay, and so this question is related to that as well. So what are the things that would you say that are causing a rotation out of the Nasdaq and into the Dow?
Well, I mean, I think that a lot of the companies that are in the Dow are also in the Nasdaq. So I think it's just the type of companies that are being rotated out of. I mean, you have to think about it. A lot of these companies have gone on to like literally hit all-time highs. So it makes sense that, folks would want to take profit at the top, especially when we're getting a little bit frothy, meaning AKA a little bit euphoric. The
Mm-hmm.
market definitely needed a pullback. If you notice, we didn't really see any significant pullbacks on a major OPEX, meaning options expiration month, for November 19th last week. And I think that also it could be that people run defensively because of the fact of the news that was also expected. So starting to hear really what those bottlenecks really look like on the logistics side, not the supply chain, because we already knew what supply chain looked like, but now we're
Mm-hmm.
moving more so into the logistics standpoint and seeing that there are bottlenecks there and how it's impacting retailers and how people are also possibly removing some risk off of the table, that we could be seeing some risks in other arenas as well. I think that that's really where it goes into, alongside with, again, rotation across the entire board. I think that, again, it's just nothing but, I think it's temporary for the short term period, but I don't think that that stops the whole show for moving forward in the grand scheme of things for the long term strategy of growth stocks or mega cap.
All right, here's a question for you. This is for you, actually, Mark.
Oh,
Dang it, I was gonna try and do a voice, but it didn't come out. Is Mark worried about FTNT, or are current prices just related to inflation concerns?
I think that current prices are probably just related to inflations and concerns.
Mhm.
I mean, when you start thinking about anything when it comes to inflation, you think about deferred revenue, or say, for example, the discount on those cash flows. So I think that that's really where it comes down to. But all in all, I'm not really worried about FTNT. Um, I guess my price target, alongside where I'm probably sure that many other folks, is probably around 450, 500 for FTNT. So yeah,
Not at the end of the year, but
no, in the future.
yeah.
over the
I just
over
want
the
to make
next over the
sure.
next year to 2 years, I suspect that they'll probably be a $500 stock.
Yeah. Okay. So here's the question. We missed the rotation last year. Hold up. I didn't miss no rotation. Mark didn't miss no rotation, but okay. So let me just rephrase this. Some of y'all Missed the rotation last year. Can you talk about where the whales are moving this time around?
Well, I mean, when you find yourself in a market where the market gets more defensive, like let's put it into perspective. If you look at the S&P 500, 29% of the S&P 500 is information technology. Another 14% of that is probably consumer discretionary, and then you got about 10.6% being financials and communications. And then so if you really think about that, or also health and communication, and then on top of that you also have financials. If you really think about that, just like within those 4 out of 5 alone, and if you just think about it, that's over 50% of the entire S&P 500. So that's not including industrials, that's not including energy or any of those other things. So really, where is it that people run to? They go to places in which that are defensive, that are also non-impacted to inflation, or inflationary risk, or even interest rate hikes. So you look at energy, consumer staples, materials, financials, and you can even look at industrials as well. Those will be the arenas, and if you think about it, it kind of makes sense because you're going to go to the places in which that are the lower hanging fruits. If you really look at energy, energy represents energy, commodity, or energy, materials, and I would probably say a few other sectors. They are
Mm-hmm.
probably about anywhere from 4 to 2.5%. So if you think about it, it makes sense to run there defensively or just go straight to cash. And that's ultimately what you're going to see the market do. When you see sectors like real estate, materials, energy, and some of the others that are normally not there, like consumer staples and utilities, then that's a sign that essentially that the market's gotten defensive. In a defensive market, that's where people go. When it's non-defensive, they go back to the things because it's a signal of we want risk on. So when risk turns on, then we go to the larger sectors.
Mm-hmm. And I also will note that if you, on a day like this where you see the NASDAQ is down, but like the Dow is up or the S&P 500 is up, or mainly when the Dow is down and the NASDAQ is up, if you just go to the CNBC app and look to see what sectors finished in the top as far as performance goes, for that percentage change, you'll see where the money is really going.
Mm-hmm.
So Mark called out all those sectors, and I'll further note that all those sectors are green. The only sectors that were not green was technology, communication services, and consumer discretionary. So
And I
that's
think
just
if you
something.
add those up, that represents 52% of the entire S&P 500.
So there you have it. So when you, again, when there's a red day, and specifically when the NASDAQ is down, especially when it was down by over 200 earlier in the day, and then it kind of tried to fight its way back to something respectable, but still at a loss, you'll see that the money most likely is going to those other sectors that Mark called out. So today, if you took a screenshot of the sector's performance today, you'll see that like perfectly illustrated how Mark just explained it. So totally. All right. So let me see. There were some other questions here, Mark.
Okay.
Okay, some of these questions were just answered. Um, what's your this one's for you. What's
Okay.
Mark's buying strategy on a red day like today? What are the do's and the don'ts?
Never subsidize winners for losers. So if it's a loser, don't try to like just jump into it and say, okay, hey, it'll come back up. If it's a loser, it's a loser. I mean, flat out, point blank, period. Second thing, uh, you know, pay attention to sentiment. I try to pay attention to sentiment and also follow what my thesis is, that I'm sticking to the script that I wrote earlier in the year, or that I just follow from, years past, which has been the same thing over and over. Um, and then on top of that, I mean, I don't get scared of red days at all. If anything, it's like, I take the opportunity to say, okay, hey, if I have the full deployment of cash, then I'm sitting there and I'm waiting. I'm okay. If not, then essentially, and if I see that the opportunity is so good, like, if you saw a Tesla down by $75 a share, I mean, would you not take it? So if you saw Amazon down by $200 a share, would you not take it? I mean, does that not produce an opening? Um, so for me, that's how I look at it. I say, okay, hey, does it provide me an opportunity? Is it an opening for me right now? And if I do have a position that ultimately is a loser and has been losing for quite some time, then I just got to say goodbye. We can't be friends no more. So
That's fair. What chart is used the day of buying a contract? Example, a 1 day, 1 minute question mark.
actually, no, I don't really look at the like on the 1 day or the minute. Like if I'm looking at that, I'm looking to just get a good gauge as it pertains to where the overall index is headed. But for the most part, um, honestly, it's like when I'm plotting out something, I'm looking at something on the daily or the weekly. So over a year or year to date chart, I'm looking at
Mhm.
it from a day on a daily basis or on the weekly. I believe that the weekly chart gives you the most accurate reading of the market, and the daily just kind of like gives you a good gauge as it pertains to where are we in the grand scheme of things of looking for a signal versus cutting out noise and looking for confirmation.
Okay. What is more important, outside the bands or lowest RSI?
Say that again.
What is more important, outside of the bands or a lowest RSI?
Hmm. I would say the RSI because the RSI can give you a definitive reading to let you know if something is completely oversold. Um, like for example, you can see something outside of the bands, and that can happen. Say for example, within 1 day. That doesn't mean that the RSI has gone down to oversold. It just means that it's gone. We saw something move outside of the volatility, and the Bollinger Band is the lagging indicator. Just like all indicators are lagging indicators for the most part, but yet at the
Mhm.
same token, it's like the RSI kind of gives you a better gauge. Um, so that's how I see it. I think the RSI is probably a better read than the Bollinger Bands. But can you use both? Yes. I wouldn't just bank anything off of just one specific indicator.
Okay. Great. If you are a high school student with $20, would you save to purchase higher stock or just get in?
Oh, and it's funny that you say that, but that'll come later. Um, if you got $20, I mean, honestly, it depends upon what your strategy is. But if you're looking to buy something, say for example, any specific stock, and you don't have the cash for it, it's okay. I know that we say something terribly about fractional shares, but there's nothing wrong with that in the short term and holding it as you build up your cash position and then move into something for something much more longer term or something that's actually much more whole. Um, or essentially, there's nothing wrong with also storing cash within your brokerage, so that way you can build it up and just be ready. So, yeah, I mean, there's never one specific way of how to do things. Like, if you really think about it, if there was only just one way to literally reach success, then everybody would have taken it, and then ultimately, honestly, we would all be successful, and then we would have to redefine what success is. But there's multiple ways, there's multiple different avenues, there's multiple different strategies. Find what works best for you and
Mhm.
focus on how is it that what strategy works the best for you without ultimately adding more risk onto your table.
Yeah, with $20, I'm a flip that outside of the market and then get into the market. But
You could do that too, see?
that's just me. All right, here we go. There is a. I feel like didn't we talk about TSM's chart
We
already?
did. We did.
Okay, so
We
for that
actually we
question,
actually talked about TSM's chart before it actually spiked.
yeah. So yeah, we did talk about that. So the question is to review TSM's chart. For the cousin that asked that, check last week's video. I believe it was Tuesday, a week ago, about a week ago. We talked about that. Okay, sorry, couldn't resist. Okay, let me see. January 23 okay, I'm gonna read it, and if it doesn't make sense, then we'll have to get back to this cousin. But January 2023, $200. I guess that's the call. It's down negative 67%. Buy more. I don't know what position this is, or what stock or whatever. Buy more or buy lower strike.
A January 2023 and it's down by how much?
Negative 67%.
I mean, I don't. Given that I don't know what the ticker is, I can't really provide any strong information there. But yeah.
Yeah. Sorry about that. So that cousin that asked that question, please feel free to um, include what the ticker is, and maybe we can answer that later, potentially. We're not financial advisors, so usually questions like that are not like answered in the detail that you're probably seeking. Okay, so you did talk a little bit about fintech earlier,
Yeah.
but someone is asking, can you give some insight about your tweet that you tweeted earlier about fintech falling?
Oh, fintech started falling because of the fact that, if you look back in July, a lot of banks said that they were going to start doing buybacks. I mean, and essentially it was approved by the Federal Reserve. And then on top of that, because they passed their stress test,
Mm-hmm.
two, interest rate hikes are expected. And then three, there is some legislation that's moving forward to literally bring down the cost of transaction fees, which is not good for a lot of those fintech companies. But it's
Mm-hmm.
definitely good news for, say, for example, banks, because of the fact that, again, they make their money not on transaction fees, they make their money on interest. So there you have it. So you saw a rotation out of fintech going into banks or into major financial companies.
All right, so I think with that we can transition.
Yay! Well, on that note, transition. Welcome, sophomores. Welcome, 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 welcome. It's been a long road coming, but we made it. All right. So, it's been a minute since we've had the opportunity to do this. I really miss doing these types of presentations. You guys don't know how much I miss it, but I mean, honestly, I had a lot of fun doing these. So I wanted to bring it back because of the fact that, honestly, I feel like there's some good information here for everybody to just literally pick up on, and on top of that, for it to leave as a placeholder. So welcome everybody to the Come Up Series School of Investing. Shout outs to our freshmen that are in the room. Hey, what's good? Hello, hi. We'll give you a somewhat of a catch up. And then on top of that, welcome sophomores. If you was a sophomore in the room, I want you to just go up and I just want you to throw, either some flowers or, say, for example, a shades emoji in the chat. If you're a freshman, just go up and throw up a money bag in the chat. That way we could just know exactly who you are and everybody is present and accounted for. But each and every single one of you, welcome to year 2. So honestly, I'm really, really excited. I look forward to doing more of these. So let's get into it, shall we?
Yes.
All right. So mission statement of year 2. The future is not something we enter. The future is something we create. Let me run that back for y'all. The future is not something we enter. You don't enter the future. You create it. So this is what it's going to be about. But at the same token, we're going to just do a slight little look back so that way we can predict some things. All right, so sophomore year is here. So take advantage of the tools that are available, as we always say here at the Come Up Series. So we're going to give you a quick recap, then we're going to get into this year 2. We're going to show you how the board is set up. We're going to do the blueprint, and then, of course, stay focused and disciplined. Y'all with me? All right, let's get it. All right, so remember that 98% of investors and traders lose 100% of their portfolio trading on just speculation over time. 98%. Now, it's like, I wanted to put this here because of the fact that, honestly, if you remember way back when, if you look very, very closely at this presentation, you'll see something there that was literally executed at one point in time. And ultimately, look at what it created. For those of you that know, if you know, you know. If all of our sophomores in the room should know exactly what you see on the screen. If you don't, that's okay. Just, in the words of Coach Head, just make sure you wash your hands. All right, so the game plan is simple. Just to give everybody a refresher for all the freshmen in the room. Study and assess building a trading plan, a method for identifying and trading that takes into consideration a number of variables including time, risk, and your objectives. So just remember, if you literally place a long-term trajectory on your positions, you tend to, like, the longer that you give yourself time, the more risk you remove off your table, and on top of that, it makes it easier, or possibly easier, for you to reach some of those objectives. That's the goal. We introduced this thing called the rolling fours way back when, but don't worry, we got something for you. But it's pretty much just a way for you to give you a blueprint, so that way you can execute and journal your process without really having to think about it. All right, so our process for strategically buying 4 times each year, or two, you can either do it 2 or 4 times a year, with the money you saved from your income. AKA, if you can get to 70% saving of income, which is preferred, yo, you are like literally on some Mount Rushmore status. Kudos to you, goats, to all of you. If not, there's always room for improvement, because we're always trying to get better, including if you're on the 70%. And if you've already mastered that, then hey, get to 80. There's always room for improvement across the board. And the focus is that essentially it's not about buying the most fancy cars and all this other stuff. But if you want to have those things, by all means, God bless, go do it. But the main focus is you got to change the world. You got to leave this world better than the way that it found you. And that's where we call it the new Roaring 20s, which we're entering into now. We're getting ready to go into 2022, which is a year of expansion. So stay focused with being disciplined, with your discipline that you created, generational wealth. Now, just keep this in mind. With generational wealth, many times people won't be able to even experience generational wealth, but the people that come behind you will gladly thank you and be totally appreciative of all the things that you've been able to pass down and pass on, because of the fact that your awesomeness was definitely there, and that's what makes you legendary. Now create and rebuild the community that pretty much raised you. Okay, so let's break it down. Institutional versus retail investors. Who has more buying power? Institutions. The institutions are large market actors such as banks, mutual funds, pensions, and insurance companies. Probably some of you are tied to an institution somehow, some way. If you have a 401k or pension, if your money is being managed somewhere through your job, then most likely you take part in the institutional activity. So, which means they can't really be betting against you if they're 9 times out of 10, you're their customer. Who has better analysis with the data? Institutions also have the advantage of professional research, traders, and portfolio managers guiding their decisions. So essentially, if you think about it, JP Morgan is significantly a company that has a ton of traders, that has a ton of researchers and portfolio managers, but never fret, because of the fact that a lot of this data has become widely accessible across the board. You just got to know where to look, and you just got to learn how to analyze it. That's all. And if you notice, here's the thing about a lot of folks who get their Series 7, which, they're certified to do what they do on the stock market. They take an exam where they learn all these, or where they pretty much learn how to memorize all these things. But doesn't mean that just because they have their Series 7 that they know all these things. There's a ton of folks that I know that have their Series 7 that didn't know anything about long-term leaps or options or anything like that. They avoided it like it was the plague. And now all of a sudden, they're literally just like out here crushing it in the market because they learned a new skill. So if they can do it, and if they're humans, then you can do it too. All right, so is the board even fair? In most cases, no. But as a retail investor, you have time without pressure to perform. Most of the information is publicly available. If you're dealing with publicly traded companies, then it's public knowledge, and it has to become available, because that's technically the law. And then on top of that, you don't have to worry about like reaching some type of performance benchmark and worrying about if your job is intact. Most of your institutional money, they are tied to the S&P 500, which is ultimately the overall benchmark for the market. If they're not beating the S&P 500 on a consistent basis, then 9 times out of 10, they probably will not have their job. So there's that. So, all right. So we talked about this thing a little bit called options trading. For those in whom wish that needed a quick refresher, let's say that if you traded Apple, the price target was 150 in 2 years. Interesting. Maybe that was a clue. Maybe it wasn't. But let's just say that if you had stock investing back when Apple was $100 a share versus options trading, one contract equals 100 shares. So if you had 10,000, you divided that $100 per share, that gives you 100 shares. Meanwhile, since that one contract is 100 shares, you would multiply 100 contracts times 100 shares, that gives you $10,000. So meaning you can buy 100 contracts, and then ultimately that's the equivalent if the contract value was at $1 in its premium. So now let's take those 100 shares that you own, because you own them, and you multiply that times $65, because AKA that's the profit that Apple goes up by. Very interesting. Again, y'all remember this, but it's kind of funny how like we're here in the current, but way back when this was interesting. All right, so let's say that it went up by $65 a share. You're up $6,500. But if you did it in the options contract, and let's say that it got up to 125 and the premium went up by $4, $4 times 100 contracts times 100 equals how much? That's that new math. Y'all remember it. So just as a heads up, that was the new math. That was literally how we literally put it out there for everybody. So then we got into this thing of like, okay, hey, how do you buy such an option? So let's say that if you bought the option, like 9 times out of 10 when you buy an option, because you can only buy options when the market is open from either 6:30 or 9:30 a.m. to 1 p.m. or 4 p.m. Eastern time. So let's say you buy open and then you sell close. So when you want to sell, you sell it close. But when the market's open, you buy it open. So let's say if I buy 100 contracts for January 2023 at $500, you see that there's an ask price and there's a bid price. The ask price says what I will be able to buy at, just like if I'm buying a home, and the bid price is like as if there's multiple bids for the house. That's exactly what I will be able to sell at. As you can see, the last price there was at 21. So I set a limit there for just to say, okay, hey, 21 bucks per premium is essentially what I'm willing to pay. If I want to execute it at market, then that just means that the order will immediately go through. All right, and then boom, there's my commission, good for the day. Boom, my preview and place the order. Now, let's say that I've been in this position for X amount of time, or let's say I was in this January 2022 at 470, and let's just say that, hey, I'm getting a little bit, antsy, I want to move over into something else. So there's this thing called rolling. So remember what I said, you buy open and you sell close. So if you bought it open, you have to sell it close. So in this particular case, you will do a sell close at 100 contracts here, just for learning purposes. And essentially you would buy open. You see how to make the adjustment. I made the adjustment so that way essentially in the quantity, so that way it adjusts based upon the asking price. Because the asking price or the bid price is now $9.45. But the asking price is $39.29. So if I wanted to make it adjustable so that way I'm not having to pay or come out of pocket, what I can do is I can roll the call into something else and ultimately essentially balance it out as close as I can to zero. And ultimately, hey, I even walked away with $140.15 in this example. Pretty dope. And that's ultimately how you roll it, because you're just giving yourself more time with a different strike and everything else. Very, very interesting. Something to pay attention to. Okay, so let's start year 2, because I just literally went through all of year 1 in a matter of probably like 19 minutes. So hopefully I didn't go fast or too fast. But the beautiful thing about YouTube is this is recorded, so you can always come back and rewatch it. All right, so let's start. It's all about see the future by learning from the past. Interesting, right? So if we seek wisdom, not knowledge, knowledge is of the past, wisdom is of the future. So let me just replay that for you. If we seek wisdom, not knowledge, knowledge is of the past, wisdom is of the future. Something to, just keep in the back of your mind. Okay, so did the past lead us here? Well, yes. So let's talk about fintech through time. Now these are some interesting dates here, like on the market. So let's just take a look at it, right? So for example, we got 2007 to 09, we got 11 to 13, 2014 to 2016, 17 to 20, which my goodness, and then 2021. We went through some stuff, and if you're watching this in the future, we definitely went through some things. And here are some of the things in which how we got here. Here are just some of the interesting things to take into consideration. Financial crisis was the previous crash back in 2007 to 2009. Then there was an underemployment, and then that's when there was the birth of the gig economy. Interesting. 2014 to 2016, housing and student loan chains. So the chains, really started to formulate. And then 2017 to 2020, pandemic and recent crash. And of course, we assumed that there was going to be a recession. And then 2021, buy now, pay later. How does that even fit? How does buy now, pay later fit in the grand scheme of things? Well, it's very interesting. Let me run this back to you while I keep it into perspective. Financial crisis. We had pretty much the fall of the housing market, and essentially it really destroyed a lot of the middle class homes out there, and essentially it put a lot of strain on a lot of parents out there that really couldn't fund a lot of their children's education. So what did they do? They had to go even further into debt, which ultimately therein, when a lot of the students that were coming out of college from really 2008 to really 2012, they were really struggling to really get into the job market and also make significant wages that were ultimately that they expected. Why? Because when they came outside of college or when they graduated, they walked into a new era where they were literally having to compete against baby boomers, Gen Xers, and their counterparts as millennials. And that was tough because then you started to see a huge amount of underemployment, and thus the gig economy was born. The gig economy, where, say, for example, you were working by day and then also driving Uber by night. And they did some pretty phenomenal marketing to make it look super duper cool, and, even to this day. No shade towards anybody who does it, because by all means, make your paper. The bills won't pay themselves. So we get it. So then we move on to the housing and student loan crisis. Because mind you, that's when we started seeing the reports of, student loan debt is starting to get astronomically high. And ultimately, a lot of these students are coming out of college and ultimately starting to face significant issues. So let's think about it. If you now have a job that you're unemployed on, so you're underemployed, not unemployed. I didn't add that in there, but there's also that too. But if you're underemployed, which means that you're making less than what you should be making because of the fact that ultimately competing wages. So then you have that. So housing situation is terrible because of the fact that most places require that you pay 30 times the rent or 3 times the rent. So, and then on top of that, you saw this in a significant amount of international buying, where you saw a lot of international investors start buying up tons of real estate after the financial crisis, because of course there was a lot of homes in foreclosure, which therein we saw the birth of, say, for example, the Airbnbs and all that other stuff, where people started creating rentals, which ultimately jacked up the price against the folks that were locals that lived there. So now it raised the price of housing and everything else. That was just through beginning in 2015, 2016. So now we got all these students that are walking out with student loan debt. Now they're now having to rent places. So they're already dealing with the inflated market, because now they're having to deal with, like, if you think about it, your main bills take up 50% of your entire, paycheck. And then on top of that, if we add on, say, for example, student loan debt, then it starts to get a little bit more interesting. So now we get to this part of the pandemic. And so essentially it's like, okay, hey, now we're asking ourselves, like, okay, hey, can things actually hold on? Luckily, air quotes, we had this thing where student loan debt was on this temporary forgiveness, where a lot of folks could defer their student loans. Doesn't mean that you don't have to pay them. It just means that essentially that, hey, we'll forgive it for now for you being late. Now think about it. Think about what I just said. All these types of financial burdens that have now been placed. And now we find ourselves in a situation where people can't afford a lot of the things that they want to buy. Well, what must companies do? They have to get a little bit more creative, right? Because in order for retail to continue and consumerism to continue, then ultimately we birth this thing called buy now, pay later. Now, it's quote unquote the new thing. Is it really? Or have they already existed? A la credit cards 2.0, 3.0? Who knows? But let's go ahead and give a little detail here. Back in 2011, Forbes had posted an article talking about the new pay gap, boomers and Gen Xers and millennials. Then they came out in 2016 and said, okay, new study reveals that millennial underemployment is on the rise. Interesting. And then 2018's housing market looks good unless you're a first-time millennial buyer. Okay, and then here it is as it pertains to, from sources from the Federal Reserve and Experian, which is a credit bureau, about 1.57 trillion. Now, at the time of this article, this was about March. Now, as of September, this number is a lot higher at 1.7, but we'll just take the number for what it is. 1.57 trillion amount of student loan debt outstanding in the United States alone. 30% of college attendees taking on debt include student loans to pay for their education. And then 38,792 average amount of student loan debt per borrower. And then 5.7% of student loan debt that was 90 plus days delinquent or in default. Now, we don't know what the full on onslaught of those numbers are because of the fact that, why? Well, we had this major hold that took place in 2020. So it should be interesting exactly what it looks like, especially since we saw a lot of people, literally firing their jobs. Thus, cue the buy now, pay later. Now, there's more than just Affirm there. There's Klarna, then there's Afterpay, but a lot of folks know of Affirm because they've been in the news very heavily. So, like, Affirm has just been literally, like, taking up a lot of market share as it pertains to getting into there. I think they're now in Best Buy now. They also in Amazon and many other retailers. But think about it like this. 57% regret making purchases using these services due to hidden fees and interest. Time Magazine. Interesting. Now, who are the folks in whom which that are the majority that use this? Millennials and Gen Zers. They are the largest demographic when it comes to using buy now, pay later. And it's kind of interesting because it's not just them, right? Look at Apple. If we think about Apple when they came out with the credit card, they don't operate as your typical credit card does. They actually give you a lot of options in which that you can literally set it kind of like a buy now, pay later feature, but yet the interest charges and everything else, they roll up on you pretty quickly. But it's just something just to think about. Imagine if your high school student has an investment portfolio, would they need these services? Just take a step back and think about it. Would our children need these services if we start teaching them now the value of money? One, two, start improving their relationship with money, and then three, teaching them how to invest in the markets. Interesting, right? So what does that look like? Now, if for those of you that are like, you haven't been around for the past few months, there was this thing that we dropped on, called The World is Your Portfolio. And it was a very, very heartfelt episode, but here's the breakdown of this. Many of you have seen this, so here's a simple breakdown. If you had $2,500 and essentially if you just trade it twice a year, or if you did it, say, for example, even once, then essentially you could probably find yourself in making these types of returns, hypothetically. So, for example, if a person traded twice a year, so for example, if they did, let's say that, a person wanted to do a 1-year call with a 6-month exit, then they can literally do, if they averaged a 150% return, then that 2,500 turns to 6,250. 6,250 turns into 15,625 by the end of year one. And then so on and so on and so on and so on. And then it's discipline. And it's like, these are not really imaginary numbers. This is math. And then it's like, if you've taught your child ultimately how to literally, go from turning their investments into a system in which that they can start paying themselves and ultimately still consistently buying in stock. Here's the secret to it. Like, here's where the really big secret is. It's kind of interesting because we left it here as this one. Jolynn, I want to gather your thoughts on this. You ready for it?
Yeah.
How does this look like for a movie, a movie thumbnail? I would call this movie "Stick to the Script" and "At the Money Joint" featuring the S&P 500, aka the Spire SPX. And then it would be pretty much the beneficiary, aka the executive producer, would be one of the cousins, or every single one of the cousins. They're the beneficiary, aka the wealth builder. And guest starring within it, they would have XLK, XLY, SMH, VOO, VTI. They could choose from as it pertains to guest starring the ETFs and index sectors. And ultimately, just think about it. If you stick to the script and stay at the money and just really focus on the S&P 500, you, the beneficiary, can probably essentially one day build wealth for yourself if you stay disciplined. And on top of that, if you still want a little bit more diversification, you can also look to some guest stars that can ultimately star in your movie. It's not that hard, people. It's just more so in the sense of, just making sure that you just stick to it. You know, again, we say it all the time. We are our ancestors' wildest dreams. So, you know,
Okay.
we didn't really have another, title. So I just, I left it blank because that lets you know that we got a continuation going. And so I'll just leave it with this because I'll leave it with how we all started in the beginning. The dream is free. The hustle is sold separately. This concludes your sophomore orientation. I'll fade to black now.
I do want to point out that that example is for one portfolio that you really don't mess with. And if you want to, be in these streets, in these market streets, testing out theories or whatever you else you want to do, you can have a separate account for that. But
Correct.
you set up this account, like that is your account that you just really do not like, don't make no withdrawals from it. Just have it there working in the background for you. And those numbers, those are real numbers.
Correct.
And that's why the new math is just so I was I was watching the first episode of Wealth Rituals and that new math. And when I think back to that time, I'm just like, oh my gosh, that's wild. Like how it felt to like really fully understand like this is real. This is really attainable. So yeah, I advise everyone to if you're gonna do the rolling fours, like have a separate account that's for the rolling fours only and don't touch it and just watch what happens.
Yeah, I mean, and honestly, it's like I'll look at it like this. I want to say something that's going to be pretty heartfelt, and it may it may I don't know if it may ruffle feathers or whatever it is, but I'll say it anyways because honestly, it's the truth. Y'all, stop treating us like we're financial gang members. We're not. Like for real. Like you don't see Tony Sakanagi and ultimately Dan Ives or Kathy Wood or anybody else out there doing drive-bys on another. They don't do that. This is not that type of energy. It's not that type of game. The folks, if you really think about it, the folks really within the financial space, they know each other. They're friends with each other, or essentially they just respect each other's craft. And their focus is to make money for their clients. 9 times out of 10, institutional investors and sometimes retail, but for the most part, they're focusing on improving their craft. It's not about, well, I'm part of this group or that group or whatever. Who cares?
Mm-hmm.
It's like what matters is that hey, that group, whether it is you could wear it like a badge of honor, but you know what's a bigger badge of honor? Knowing that essentially you don't have to worry about how this month's bills are going to be paid or how this is going to be taken care of. You know what really matters? Ultimately, like being able to say that, okay, hey, my children are set. The reason why it's like I'm so proud of Tajay for being able to talk his talk out here is because of the fact that he just did something simple. He learned what he needed to do, and ultimately he had the discipline and he stuck to the script, just like many of you cousins out there are doing so. So I don't care if you're a part of whatever financial group that you are, and you happen to stumble across us and say, okay, hey, I like what they're saying. Cool, dope. Keep learning, keep researching. That's what it's about, and execute. None of us are going to be pushing the button for any of your portfolios, none whatsoever. So it's all going to fall upon you. You're going to have to make that distinction and say, okay, hey, that this is what I want to do, and this is how I want to do it. And if it makes sense to you, by all means, move forward. If it doesn't make sense, that's okay. Keep moving forward and keep learning and keep seeking the knowledge and the wisdom and the answers so that way essentially it can make sense. It's that's really where it comes down to. The greatest gang that you can ever rock with are the folks in whom which that ultimately that depend upon you every day, that literally depend upon you to keep the lights on. Those are the folks that's the best gang that you can ever have. It could be, your spouse that you lay next to and that you go through, this world with. It could be the children in whom which that you live and you would give up everything for. That's the greatest gang right there. Honestly, we gotta cut this like type of mentality where it's like we have to bring in all this other BS type of, you know, mindset and thinking, because that's really the poor man's thinking. You know, what we're trying to do is help each and every single one of you elevate your conscious, and on top of that, help you elevate your wealth. That's the focus. You know, we focus every single day, you know, how is it that we can like literally elevate to make this even better for each and every single one of you. So that way, me, I just don't want anybody to have to suffer the same pitfalls that I've had to suffer throughout my investing and trading career. My goal, my benchmark, just like if I was to set my benchmark, just like how Wall Street sets its benchmark. So again, what I said in the presentation, S&P 500 is the benchmark for a lot of your institutional money managers and traders. If you can't beat that benchmark by a certain multiple, then you're out. It's done. My benchmark is, I don't compare myself to every single other platform out there. I don't. I literally set my benchmark based upon the knowledge of every single question that comes through. If I'm hearing the same question that each and every single one of you are asking over and over, either I have failed you or you weren't listening. Or, hypothetically, maybe you're new. But it's like, that's ultimately how I set my benchmark. And the other benchmark that I set on is the ultimate goal, which is how many folks have been able to like literally be financially free. That's the goal. You know, I looked at it in this limelight where it's like people that are in this space, which I'll tell you from day one, and Jolyn will tell you, I wasn't like looking to literally be on the front of anything. You know, honestly, when I found out about what Jolyn had posted, I was in hiding. Legit.
Man, I called you out, homie.
Yes. No warning, no nothing. But you know what though? I thank you, Jolyn, for being able to do that. I learned a lot in this process. And at the same token, it's like I look forward to each and every day. My biggest challenge is, how is it that I can consistently make this better, more digestible, entertaining, so that way it sticks. And on top of that, compete against the other garbage that is out there that doesn't produce revenue generating conversations. That's my benchmark. That is literally the benchmark every day. So people getting better every day, and their portfolios and their wealth getting better every day. That is our benchmark. If that's not happening, then we have failed.
Mine would be based on, I guess I need to start keeping track based on the number of folks that are like W2 who. I mean,
Yeah.
you could work if you want. There's no, if you want to. I don't want to, so that's how I look at it. You can have a 1099, that's cool, whatever. Or some, business contracts where you're in control, where you have the autonomy to say yay or nay. That's more so the life that I would like to see, not only for myself and those who come after me and those who are, around me, but for all of the come up cousins too, because there's something to be said about being able to wake up and contribute your gifts and your talents the way you see fit.
Facts.
However that looks, so I can't believe that this is, year 2, so to speak. It's kind of weird because, we didn't, it's not like when we set out, it wasn't like, okay, we're going to do this and then we're going to do this, do this. It was just like, we did it. And as we were in it, really the vision, got clearer and clearer and clearer as we were like doing the work and taking the temperature of, y'all to see like what is needed, what will advance, not only just the culture, but what's also going to close this racial wealth gap. That is a big, audacious goal.
Yes.
And it is being met every time someone is in the mindset to sit down and learn and to research and to, make out their trading plan and all that. Like, that is a part of closing the gap, and it gets smaller and smaller every single day. Like even when some of the cousins are learning lessons, like very difficult lessons, that still assist in closing the gap.
Yes, it does.
And I'm just so honored, really. I'm honored to be a part in some way, shape, or form of that racial wealth gap closing, because I know that when Julian Jr. is out here, strutting around in all his or her glory, this notion of, oh my gosh, I get to create however I see fit. I can create something, and because I find value in myself and I know my value, the things that I create also have value that people are willing to exchange, energetic dollars for or whatever.
Yep.
So that's what really keeps me going. And it's just wild that this is a year, and we are 2 minutes over time, and we do have some announcements. Mark, there was something you wanted to.
Well, I think it's part of the announcement. So did you want me to give the announcement?
I think I have my own announcement.
So, well, then you go first. You go first.
No, you can go. You can go, because it might be that. It might be that.
Well, I'm just letting y'all know that come December 1st.
Yes, that's my announcement too.
Okay. All right. So I think it's pretty much unanimous here that the Come Up series is definitely going to be like, y'all, I need a vacation, like flat out. And I'm probably sure that Jolyn needs definitely a vacation. So we'll still be doing Tuesday episodes, but Thursday episodes will be on hold until we get back from vacation, which will start at the end of, I think, the final week of the year.
Did we decide that?
I don't know. Well, or it'll just happen to start in January. Gyms will still be dropped on Tuesdays, but yet at the same token, it's like I'll be pretty much on vacation alongside Jolyn. She'll be going on vacation as well. So, honestly, so that was no burnout.
But honestly, Mark, we are being very generous.
We are.
Even though we're going to be on vacation, still showing up on Tuesday. So Thursday, we just had to,
But yeah, Tuesday, that had to.
We're committed to being here on Tuesday, y'all. So
I think the biggest thing is and also it's like shout out to our spouses also, because for real. Significant sacrifices are made in order for this to literally exist. So, Erica and Brother Omar, wherever you are, sir, honestly, we salute both of you and thank you, because honestly, without you two making the sacrifices and allowing us to just be creatives and to literally put this, this task on our shoulders and carry it up the mountain, honestly, we know that you share that with us in your own way. So we truly, truly are appreciative, and we're thankful for that.
Yeah. So in December, your girl is going to be on vacation, living life. But on Tuesdays, I'll show up.
Yeah.
I'll show up down to the Zoom.
Yeah, I'll definitely be out here.
Yeah. Also, another announcement. So while we're on vacation, y'all, on the Thursdays are going to be on pause. We still, because we are just so nice. Okay, we are really nice. No, not really. I don't consider myself nice. I just am what I am. But if I rock with you, I rock with you. Okay, so we will have that's true though, Mark. We will have some videos dropping.
We will.
So
I guess I should make that announcement.
Yes, go ahead.
So given in our absence that we will not be here on December 2nd, literally an episode will be dropping thanks to Steve, who has been super duper gracious and diligent in working on XYZ. He's actually loading it in the queue right now. So yeah, I'm going to do the final look over of that episode, so it should be pretty interesting. So we'll look to drop some episodes while we are definitely on vacay for each and every single one of you. I don't know about Wealth Rituals yet, because that's gonna be like, I don't know if that's gonna have its own like kind of like a Netflix rollout where you have the whole season, or I don't know.
Well, you know
But
how we do.
I just know.
No, we're not releasing the whole season.
No.
No, it's not gonna be Netflix. It's gonna be like Hulu, but if you got premium, no commercials. If you don't have premium, I'm sure there's commercials. I don't know how that side. I don't pay attention to that side of things, but there will be a new episode, season 2, episode 1. The series premiere will drop in December. I have not set the actual release date. There's some things that I just gotta make sure that
tighten up.
They're like, crispy, and there's like a nice little bow on top. But it will drop in December. So the first episode, December, there will be the wrap, aka Wealth Rituals After Party, the wrap. I know, I just be thinking of these things, So anyway, the wrap will happen live on Instagram after that premiere, so we can, kiki and have a confetti moment, for season 2, because it took a lot. Really did take a lot. And we're filming more episodes for Wealth Rituals season 2 tomorrow. So.
Yep. And while that's dropping, I'll be sitting out there, with my toes out, eating some vanilla ice cream, something somewhere.
Yeah, my toes will be out somewhere.
Also, here's another announcement. Shout out to everybody that stayed in the room, because essentially we got another announcement.
Yeah, go ahead.
So we got a wonderful guest to take us out for the season finale for pretty much, November 30th. Shout outs to brother Dan Ives coming back to the stage. So cousin Dan is coming back, and of course, I hear he's not going to be the only person coming from Wall Street, because we got to run that replay back. And honestly, I don't know if you saw that interview that we had last time with Dan Ives. But we got to bring back Cousin Q. So Cousin Q will be coming also to the stage to rock with us as well. So honestly, it should be pretty jam-packed. And then when we get back in January, you never know. There may be some other wonderful analysts that will be coming to join us as well and sit down and, discuss. So stay tuned, y'all. Stay tuned.
Yeah, stay tuned. Yeah. So I feel like December, despite us being gone, we'll still be here on Tuesdays. There will be stuff dropping throughout the month of December. So this will be the time to really keep the ritual of watching on the Thursday. So what you can do is pawn the replay on something else. You can, take notes. You can have a friend join you. Something. Stay sharp, because when we come back, we are gonna, there's not gonna be like, okay, orientation. No, we hitting the ground running. So y'all gotta be ready. Shoes laced. Okay, don't play.
Definitely. Yeah, definitely. You gotta have your shoes laced. But it should be fun. So just want to say thank you to all of y'all. We're, November's not over yet, but I just definitely wanted to be thankful, because as we go into, Thanksgiving, I think that we will not be having the Come Up series on Thanksgiving Day.
Oh, I don't celebrate Thanksgiving. We do Plantsgiving over this way, and we won't be here that day. So this is our last show for this week.
Yes, and then we end it off with a bang with Dan Ives. So it should be pretty cool. Y'all, thank you so much for rocking with us. I know that TiVo's like, yo, it's time for y'all to roll on planet here. So thank you to each and every single one of y'all. We are thankful for each and every single one of you just taking your time out of your evening, your schedule, to sit down and just listen to us. And it really means a lot that we've done it now for 2 years, and we look forward to many, many more years. And of course, maybe even a passing of baton after our time is done. But shout outs to each and every single one of you. Until next time, I am Mark Monroe.
And I'm jolyngc, and the place to be. Looking forward to going on vacation, and before going on vacation, grabbing something to eat, because I'm super hungry.
Okay, there it is. And this has been your Come Up. We will see y'all in the next one, which is next week. Peace, y'all.
Yes.